So we'll start with a very important reading number 8 of the CFA level 3 curriculum that deals with the behavioral biases of individuals. So we'll start by understanding cognitive errors vis-a-vis emotional biases. Understand the two categories of cognitive errors in detail, namely belief perseverance that deals with conservatism, confirmation, representativeness, illusion of control, and the hindsight bias. We'll study the cognitive errors related to information processing, that is anchoring and adjustment, mental accounting, framing, and availability. So for each of these biases, we'll first understand the bias, the consequences and implications of the bias, and how to detect and mitigate each of these biases. We'll then move on to studying some emotional biases, namely loss aversion, overconfidence, self-control, status quo, and regret-aversion bias. What are the implications of the above biases on investment policy and the concept of goals-based investing? We'll wind up by understanding behaviorally modified asset allocation. So cognitive errors are the mistakes that individuals make due to faulty reasoning, and they could arise from many reasons: an incomplete understanding, information processing mistakes, or memory errors. So cognitive errors are the biases that creep in because of the human nature of the investor. These biases are relatively easier to mitigate, and better information and better training, better information technology can help with these biases. Emotional biases are relatively tougher to deal with. These stem from feeling and intuition. So these come from the experiences that the investor has had as a child or in his life, and these biases are more difficult to overcome and may have to be accommodated in the final asset allocation, as we'll see. Many a times it's difficult to separate a bias. So a bias may have elements of both cognition as well as emotion. Cognitive errors more specifically can be divided into belief perseverance based issues. So these are the biases that reflect an investor's desire to stick with a previous decision. So he doesn't want to fluctuate too much, he doesn't want to adjust too much. The perseverance of the beliefs leads to these errors. The second type of cognitive errors are processing errors, where the information analysis process itself is flawed. So the investor probably is not accounting for all information, or he is analyzing the information in an incorrect manner. We'll first deal with the first category of cognitive errors that deal with belief perseverance. So the first bias in this category is called conservatism. Conservatism happens when market participants hold on to a prior view and fail to adequately consider any new information. That is, more emphasis is placed on the information that was used to form the original forecast. So they overweight initial probabilities and do not adjust the probabilities for the new information. So we studied at level 1 and in the beginning of level 3 that individuals update their probability for any given event according to the Bayes theorem. So if they had an unconditional probability of an event A, let's say that the stock price is going to go up. As more and more news flow comes into the market, individuals update this probability for the new information, where B represents the new information, as probability of A given B equaling probability of B given A upon the probability of B into the original unconditional probability of A. So this was the Bayes theorem, and traditional finance says that this is how individuals update their probabilities instantly, and the market remains efficient because new news, the news B, is discounted instantly into the stock price. Conservatism says that this process doesn't happen that quickly. So Stuart Brown has carefully analyzed the historical data and concluded that healthcare stocks outperform in a recessionary environment on an average 70% of the time. Brown has incorporated this probability into his portfolio recommendations. When new information is presented that a new pricing policy introduced by the government can significantly reduce the sector's long-term profitability, Brown does not make any adjustments to his analysis and portfolio recommendations about the sector. So do we feel that Brown is suffering from any behavioral bias, and if so, which bias is it? So clearly in this example we will conclude that Brown suffers from conservatism as he fails to incorporate new information about the pricing policy. So once again, conservatism is when you stick to the old information and do not fully incorporate the new information. So behavioral finance argued that markets are not efficient and portfolio movements are affected by behavioral constraints. So these biases are some of the constraints which deviate markets from efficiency. If people do not fully incorporate the new information correctly, then the existing stock prices may not be efficient in the traditional sense or as prescribed by traditional finance. So in the previous discussion, we showed this as an example of a belief perseverance error. That is, that Brown reads the information but still wants to stick to his original view. Many a times there may be an emotional aspect is involved as well. That is, Brown may be just too lazy, or he may just choose leisure over hard work, and hence he is not incorporating the information and changing his beliefs. So if the question came in, we would generally put this as a bias of conservatism, but please note that a lot of times biases may have both an emotional as well as a cognitive aspect. The consequences and implications of conservatism is that investors can be too slow to react to new information and may end up holding investments too long. They may also at times hold an investment too long just to avoid the mental effort of updating their view. So just like effort is avoided, easily analyzable information is reacted to too often. So easy changes may be made too often as long as they involve less effort. So ironically, conservatism may at times also lead to too much turnover. So the tough information we don't analyze, and the simple ones we are reacting much too often to. So how do we detect and mitigate these biases? So for most of the biases, we see that if the investor can be made aware of this bias, or if we ourselves become aware of the biases, that's half the job done. So if we see that the investor is avoiding difficult information, or difficult thought process is being oversimplified, then we will see that conservatism bias is going to be more likely in a situation like that. So participants must try to carry out a careful and independent analysis of new information and base their decisions on that analysis. If the information is too complicated, you should not shy away from seeking professional help in case you're unable to interpret some of the information. The second belief perseverance related problem is called the confirmation bias, wherein market participants actively look out for new information or distort new information in order to support an existing view. Suffering from this bias, they tend to notice only the information that agrees with their perceptions or beliefs. What happens with this bias is that investors tend to become overly convinced that their ideas are correct. They ignore negative information, which results in holding investments too long, under-diversified portfolios, and overconfidence in the investing. People suffering from this bias may incorrectly set up data screens to find what they want to see. So if they are positive on the pharma sector, for example, so then their data screens or their filters may only be looking at the outperforming pharma stocks or the returns given by the top best pharma stocks. They may be ignoring the pharma stocks that have gone out of business or the companies that have gone bankrupt. So because they suffer from confirmation, they only want to look at the best performing pharma stocks and base their decisions on a screen like that. Confirmation may also result in over concentration in the employer's stock because they work for the employer, so they want confirmation for that and they feel that the employer's stock is going to be a good investment. So to detect and mitigate this bias, investors must actively seek contrary views and use more than one method of analysis. So if you're regularly or generally following the top-down method, also do a bottom-up analysis to see if your view remains the same or if you find out some additional information. So seek contrary views, use more than one method of analysis. Another interesting belief perseverance cognitive bias is called representativeness. So this comes from the use of heuristics. So heuristics are rules of thumb that investors derive from their experience. So as they trade every day, as they spend more time on the markets, they become biased or they develop some stereotypes. For example, IT stocks are good, or pharma stocks are good investments, or growth companies outperform value stocks, etc. So what happens in such a scenario is that an overly simple decision rule takes place of a more thorough analysis. So we see that more time the participants spend in the markets, the less rigorous their analysis starts becoming, and they start placing more importance or more weightage on these rules of thumb that they have derived. Now oftentimes these rules of thumb may work in one or two instances or for a couple of years, but they are not based on sound logic and they may not always work. For example, a rule of thumb that an investor has derived is that growth stocks outperform the market over a 2-year period. Now in a heuristic like this, the investor is exposed to making two kinds of mistakes. The first is called base rate neglect. So base rate neglect argues that the investor has mistakenly categorized new information as falling in the concerned group. For example, even if this heuristic was correct, or to derive this heuristic, a stock which actually is a value stock or actually is a normal stock is being classified as a growth stock. So this is the first type of mistake that the person can make. So because stocks are incorrectly being classified as growth stocks, that's why he's seeing a lot of growth stocks outperform the market. Second is called sample size neglect. That says that his sample is just a 2-year analysis. So the investor may be deriving too much information than is reasonable from just a 2-year sample of analyzing stock behavior. So this heuristic may have worked for the last couple of years or even for the last 3 or 4 years, but may not always work. So please understand and remember this. Base rate neglect means you're incorrectly categorizing the new information, or your new information does not fall in the concerned group. Sample size neglect argues that you are deriving too much information than is reasonable from a sample. So even if you were categorizing growth stocks correctly, 2 years is not enough a period to derive such a heuristic or use this every time. So what this will result in is that investors will attach too much information to new and recent information. These heuristics will keep changing. So some 2-year period growth stocks will do well, some 2-year period value stocks will do well, one category may do well. So if you keep deriving heuristics like this, you'll end up changing strategies too often, resulting in excessive turnover in your portfolios. So you can make incorrect decisions based on simple rules of thumb without going deeper or doing a deeper analysis. So to detect and mitigate this bias, we will address both the problems. To avoid base rate neglect, rather than quickly placing information into categories, do a deeper analysis and then decide whether a stock is a growth stock or a value stock. To avoid the sample size neglect, use a periodic table of returns. That is not just 2 or 4, use 10 years, 20 years of returns to understand whether your heuristic actually has always worked or not. So we studied 3 cognitive errors, belief perseverance biases, namely conservatism, confirmation and representativeness. The 4th one is called the illusion of control. So individuals feel that they can control or affect the outcomes when they actually cannot. So a lot of times illusion of control is related to emotional biases like the illusion of knowledge. That is, you believe you know everything about a stock, or you know everything there possibly is to know about a company. Definitely, actually you do not know everything. Actually, you can never predict whether there will be a tsunami or whether there will be an earthquake, or possibly what kind of regulation may come in and affect that sector or that stock. So people suffering from the illusion of knowledge think they know everything. They tend to self-attribute things. That is the belief you personally caused something to happen. So if the stock price went up, it's because of your view and because you told people that everybody bought the stock and you've actually caused the stock to go up. Overconfidence also stems from the illusion of knowledge. So you overestimate your reasoning abilities or your intelligence, and you feel that your analysis is going to be the best. So even though you may not have the full knowledge, your analysis and your understanding is better than everybody else. That's called overconfidence. These 3, however, are emotional biases that we'll see in the coming slides. So people suffering from the illusion of control end up trading too much as they believe they can control the outcomes. So they know when the stock will go up, when the stock will go down. They take too many calls and they trade too much. The portfolios tend to be very concentrated as they don't want to invest in other stocks that they think they cannot control. They want to concentrate all their holdings in the 1 or 2 stocks they think they control. To detect and mitigate this bias, first of all, individuals and investors need to understand the true complexity of investing. So you have to realize that you do not know everything and that everybody else also has the same reasoning abilities that you have. So you should again try to seek others' opinion and look for alternative viewpoints. Because this bias has relatively more emotional components as well, it may be tougher to remediate than the other cognitive errors and the other belief perseverance biases that we'll see. A good help to mitigate these biases would be to keep records to see if you have actually historically controlled your investment outcomes or not. Error based on belief perseverance is referred to as the hindsight bias. So the hindsight bias says that in hindsight, individuals generally perceive outcomes as reasonable and expected. So even though their investment may have gone wrong, investors normally have a good excuse that I just missed this one point, or if only I had marginally tweaked my model, my outcome would have been correct. So in hindsight, even though outcomes are wrong, individuals are not correcting their methodology. Rather, they let the incorrect models continue and tend to make statements like most of the analysis were correct, but for this one point or but for this marginal mistake that I did. So participants overestimate what they could have known. So they claim that they knew most of the things. To aid this bias, participants tend to remember the correct calls they made and forget the wrong calls or forget the errors. Implication is that you end up overestimating the accuracy of your forecasts, and it could further reinforce an emotional bias or an overconfidence bias. You also become overly critical of the performance of others because you remember your correct views, and with regards to others, you only remember their errors. To detect, ask questions like, do you remember what you predicted and why you made a particular prediction? And if the answer is that no, actually I don't completely remember, then you know that you're probably suffering from hindsight bias and you're just trying to justify your call. And to avoid a situation like this, try to keep detailed records, including the reasoning behind the forecast, to see that whether the past success was actually because of your logic or was it just plain luck, and to actually get a sense of how many errors you have made in the past and how many successes have you had. So these were the 5 cognitive errors related to belief perseverance. Let's quickly revise them once again. The first one was called conservatism, which basically says that you ignore new information or you stick to the past information, place more weight on the previous information used to make a forecast. The second was called confirmation. So confirmation says that investors go out and actively only seek confirming evidence. They even distort information so as to confirm to their views. Third was representativeness. That says that you base decisions on heuristics or simple rules of thumb. Which normally may be incorrect. And there are 2 problems with the representativeness bias that we pointed out. First was called the base rate neglect, and second was the sample size neglect. Fourth was illusion of control. This name is self-explanatory. Investors feel they can control the outcomes when they actually cannot. And the last one was called hindsight. That is, with the benefit of hindsight, outcomes always look reasonable. So you justify your mistakes also by saying that it was just a marginal miss or a marginal oversight. The next category of cognitive errors relate to information processing. And these errors essentially come because investors are human beings, and even though traditional finance suggests that all correlations must be considered and the efficient frontier with the tangency portfolio should be picked, human beings are actually not able to analyze and assess and process so much information. So information processing biases are related more to the processing of information and lesser to the decision-making process. The first bias is called anchoring and adjustment bias. That is, investors tend to be anchored to a value. So there's a target price that they had in their mind, or there was some previous forecast that they made. So the bias is similar to conservatism, which is a belief perseverance error, but this is generally based on numbers and estimates that you don't completely incorporate. So suffering from this bias, investors will stay anchored to an initial estimate and do not completely adjust for the new information. So if $100 was the earlier target price, and with the new information it should have been revised to $300, investors would normally revise it only to $150. And then they would get surprised again, and then they would revise it to $200. And when they get surprised again for a third time, will they actually take it up to $300? Wherein they could have, or they should have, ideally in the first go itself, revise the target price from 100 to 300. So they are anchored to their original target price or original estimate of $100. Similarly, if there was a negative news on the stock, then rather than selling it in the first go, investors wait for the second or the third negative news to come before they are convinced, and before they redo the analysis and realize that the stock is a sell at $100. So detection will start by asking questions like, am I staying with the stock only because I previously put a buy recommendation at a higher price? And would I recommend it based on an all new analysis if this was the first time I evaluated it? And you'll be surprised that many a times a question like this or an analysis like this would lead you to believe that no, it's just that because you are anchored to your original statement or your original target price is why you are sticking on with the investment. A completely new investment or a completely new analysis today would have made you do otherwise. So if you're aware that you may be suffering from the anchoring and adjustment, then mitigation is relatively easy. Basically, new data should all be objectively considered without any regard to the initial anchor point. A very popular information processing bias is the mental accounting bias. So in this bias, portfolios are not analyzed cohesively or integratedly like traditional finance is. So goals are segregated: children's education, buying a house, planning for retirement. So goals are segregated and different portfolios are made to meet each goals. That is, corresponding wealth is also segregated. Mental accounting also results in money being treated differently depending on how it is earned. So money earned from regular income is treated differently than money earned as a bonus or money received from inheritance. Whereas all the money is the same, it is a part of the same portfolio intended to meet the same overall objective. But even though the way it is earned leads to a different use or a different way of thinking about the money. So we'll see this many times in the review on behavioral finance, that portfolios get structured in layers, each layer meeting a different priority goal. The problem with this analysis is that investor gives up the benefit of diversification and gives up the benefit of low correlations, because if he has 5 important goals, for example, then 5 different portfolios with very low risk securities get created to meet each of those goals. Goal 1, goal 2, goal 3, goal 4. Correlations between the portfolios get ignored, which is incorrect from a traditional finance sense, because all these are actually a part of one single portfolio, and addition of any new stock to any portfolio should not just consider that portfolio but also the overall allocation of the investor. So this results in suboptimal purchases and suboptimal allocations from a traditional finance perspective. Investors may also treat income and capital gains separately. So they may feel that income is the current income and capital gains is still a part of their savings, and income may get suboptimally spent. If investors see that a lot of their goals are critical and a lot of the goals require a lot of current income, then there may be too much focus on current income, and this income may normally come from high yield bonds or junk bonds which promise a high rate of interest but are actually very risky or actually suboptimal assets. So please pay attention. To detect mental accounting, we would try to construct an independent portfolio that is required to meet all of these investors' goals. So if we constructed a portfolio from a traditional finance perspective that was intended to meet the goals of the investor. So let's say that all the goals, children's education, funding retirement, etc., can be combined together, and we derive that a rate of return of 12% would be adequate to meet all the investors' goals. And if we now construct a portfolio with this 12% in mind, and we construct the portfolio from a traditional finance perspective, and we find that a lot lesser assets are needed. Or in other words, the expected returns of an independent portfolio that is consistent with the investor's risk objective are significantly higher than the current portfolio that the investor has. So current portfolio has a much lesser expected return or needs much higher number of assets because he has over allocated to fixed income securities. Because each goal he is looking at separately, and then he's funding with very low risk assets because each goal is important to him. And the correlations are getting ignored, hence he's being able to take very, very low risk. If we consider the benefit of diversifications, then even riskier assets could have been added without significantly increasing the risk of the portfolio. Hence the expected return would have been higher for the same risk. So if we see that an independent portfolio to meet the investor's objectives and the risk tolerance is much better than what his current portfolio is, then it may be an indication of the mental accounting bias. So the mitigation is to look at all investments in the portfolio and analyze the correlations before you calculate the risk of the portfolio. The framing bias is also quite interesting, and it says that the same information is viewed differently depending on the way it is presented. So for example, a stock with unrealized gains looks like a better candidate to sell than a stock with unrealized losses. So if I needed money and I had the option of selling two stocks, stock A had unrealized gains and stock B had unrealized losses, which stock am I more likely to sell? I would be more inclined to sell stock A because it has unrealized gains. So please note that how the information is framed has a bearing on what decision we make. Similarly, if a company A has a very good investor relations team, they present the information very nicely, they talk smartly, they meet investors regularly, and basically they present the good news in a much better way, and they are able to hide the bad news. They present it, but they are able to deviate focus away from that bad news. Would you invest, or would you rather invest in company A that has a good IR team, or would you invest in company B, which is also in the same sector, is also affected by the same news, but the investor relations team is not as smart, they are not able to present the news as well, they are not able to convince people as well. So it's often seen that more investments or more bias would be towards investing in company A because people suffer from framing. That is, the way the information is framed or presented has an impact on our decision making. So if investors suffer from framing, they may end up overly risk averse or overly risk seeking. Because they are not analyzing the risk return to make their decisions, they are trading more on the way information is presented. So portfolios eventually could go either ways, could be highly risk averse or could be highly risk seeking. People become overly concerned with short-term price movement, so they sell the winners, hold on to losers, or cut their losses. So they may end up trading too often. So the bias can be detected by asking questions like, am I selling just because I have realized a gain? Or do I fundamentally feel that the prospects of this company are bad and that the prospects of B are better? If I'm selling A only because it has a gain and I'm holding on to B just because I'm in a loss, then I'm probably suffering from the framing bias. I should analyze the two investments independently and then take a call whose prospects in the future are better, and that should be the determining factor, not the fact that A has gains or B has losses. That should have no bearing on my decision. So compare the current price to intrinsic value to make your decision rather than just focusing on gains and losses. So the last information processing bias is called availability. Is referred to as the availability bias, that says that future probabilities are estimated by how easily a past event can be recalled. So there is overemphasis on information that is readily available or easy to get. So whether or not an information will have a bearing on our decision making or not will depend on the information's retrievability, on the categorization that we do for that information, so because we like trading on available information and that is easier for us to analyze, we try to categorize information into familiar classifications. So we have one particular way of analyzing growth stocks and we have one particular method of analyzing value stocks. So we may end up categorizing, or we may always want to categorize a particular stock as a growth stock or a value stock when the stock may actually fit neither. So we overemphasize readily available information. The retrievability of the information will have an impact. We want to put the information in familiar classifications so that we can easily analyze it by our set methods. How we will trade will depend on our range of experience. So if our range of experience is narrow, then our categorizations will also be narrow. So our expectations and our allocations will be limited to the extent of our knowledge and experience. So we have experience, or we have availability of stocks and bonds. We may be hesitant to include private equity, or we may be hesitant to include venture capital because we have no experience and no information about those returns. So because we want to stick to available information, we keep our portfolio still in stocks and bonds because we have more experience with them, we can easily categorize them, the information is easily retrievable. Another big problem that happens is that of resonance. So individuals assume that what interests them is also what others will find important. So just because I feel that this stock has a good market position, I assume everybody else will also necessarily have the same view. Or just because I like retail chains, I assume that everybody else will also like retail chains. Or more specifically, if I like the pizza of a particular store, then I assume that everybody else will also like that. And rather than analyzing the market share trends, etc., I just trade on resonance and I go and I purchase the stock of that store because I like it and I assume that everybody else will also like it, so the stock is a good buy. So investors suffering from availability tend to invest in fund houses based on advertising. They can even trade too much based on recent and easily available news, make decisions on low relevance and low quality news also without doing a deeper analysis. Limit investment choices to what they are familiar with. This is what we studied in the narrow range of experience. which will lead to under diversification and inappropriate asset allocation. To mitigate this bias, use a long-term strategic approach, investment policy statement that we will just study, and diligent research to construct portfolios. Do not trade just on news or on easily available news. Analyze the news, see if the asset fits in your overall strategy, in your overall asset allocation, and then purchase or sell it. So we'll revise the 4 information processing errors. The first was anchoring and adjustment. That just said that the target price or the earnings per share or the estimate will not be fully revised. We will be biased by our original forecast, and we tend to stay around the original forecast and fail to completely revise our estimate based on the new information. The second information error is mental accounting. That is, investors segregate their portfolios by their goals. So different portfolios are created for different goals. Correlations are ignored, resulting in suboptimal allocation. The third bias we studied was called framing. That is, the way the information is presented affects our decision. And the last information processing error was called availability. That is, how an information will be processed depends on how easily it is available, how familiar is the categorization, and whether or not we have experience with that news before. Emotional biases generally arise from emotion and feelings rather than any conscious thought. So the first emotional bias is referred to as loss aversion. That simply states that investors do not like realizing a loss. So they feel more pain in a loss than pleasure in an equal amount of gain. So if investors were offered a gamble that either paid plus 50 or had a loss of minus 50, most investors would not take this gamble because this minus 50 has more pain than the pleasure of this plus 50. So investors tend to hold on to losers too long and may sell winners too quickly, because if they need money, they would rather sell the stocks that they are in a profit or in which they have a profit. They trade too much by selling for small gains, incur too much risk by continuing to hold assets that have had a loss and they may be further deteriorating in quality. So because I'm not selling investments at a loss, a lot of bad stocks continue to remain in my portfolio. This may also make my portfolio too risky. So because in the hope of recovering losses, I am over concentrating in that stock or over concentrating in the deteriorated portfolio, because I've sold the winners when I needed the money and I've still held on to the losers or the stocks in decline. Loss aversion bias also leads to a phenomena called house money effect. So investors think of money gained in trading as free money. That is, if I invested $100 and 2 months later the $100 became $200, then the additional $100 that I gained are thought of as house money or essentially free money. Even though the entire value of the $200 is now mine and should be looked at as an integrated portfolio, this $100 is invested in a more risky manner as compared to this original $100, because this additional 100 is a gain from trading and is looked at as free money. So they want to avoid a loss, and simultaneously they're too happy about the gains, or they treat them as free money and become more risk taking with those gains. Loss aversion will also lead to myopic loss aversion. That is, when shown equity market returns and when shown the volatility of stocks, investors avoid stocks because they see there's a possibility of a short-term loss that they don't want to accept. So in the short run, they avoid stocks and tend to invest more in fixed income securities. However, when they're shown the long-term returns on stocks, they become more comfortable, or even though stocks have had better long-term returns than fixed income securities and other instruments, investors avoid stocks because in the short term they see there's a potential of loss and they want to avoid that loss. This is referred to as myopic loss aversion. So loss aversion could be detected by asking that, am I not selling only because I have realized a loss? If yes, then I'm probably suffering from this bias. So conduct thorough fundamental analysis, base decisions on future expectations, future prices and future outlook, not on the past performance. So whether an investment has had a gain or has had a loss should have absolutely no bearing in your decision making. So a stock A has a price of $100 and a stock B also has a price of $100. The question is, which stock should you buy? And the answer will be depends on fundamental analysis. If additional information is provided that stock A has gone from $10 to $100 and stock B has gone from $1,000 to $100, which stock will you buy? A or B? So this new information should have no bearing on your analysis. Your answer should still depend on fundamental analysis and the future prospects. The second emotional bias that we'll study is called overconfidence, which says that investors overestimate their own predictive ability. Overconfidence comes from an illusion of knowledge. That is the belief you know everything or you know things that you actually don't know. So prediction overconfidence will lead to the underestimation of risk. So individuals feel too sure about a particular outcome. So an individual suffering from prediction overconfidence will make statements like, I'm 100% confident that the EPS next year will be $100. Certainty overconfidence is when individuals overestimate the probability of success. So something like, I am 80% sure that the stock will go up. Prediction overconfidence will be something like, I'm 100% confident or I'm 99% confident that the forecast or the EPS will be between $8 to $10. The worst case $8, best case $10. So prediction overconfidence will lead to narrow intervals and more chances that the investor may get surprised. Self-attribution bias is another contributing factor. That is, people take personal credit when things go right, but blame others or circumstances for when things go wrong. So the first is called self-enhancing behavior, and the second is called self-protecting behavior that investors exhibit. So there's the illusion of knowledge, self-attribution, And even though overconfidence is quite similar to the illusion of control, overconfidence, please note, is an emotional bias. That is, overconfidence comes from the individual's desire to feel good about himself, about his intelligence, about his abilities. So again, it is not as easy to correct as illusion of control or as a cognitive error. So even after repeatedly going wrong, overconfident people still end up remaining overconfident because they have a desire to feel good about themselves, and hence they want to be seen right and they want to be right about things they do. Consequences of overconfidence is that investors underestimate the risk, overestimate the return, portfolios tend to be too concentrated, excessive turnover and transaction costs, which further eat into the returns. So the consequences are similar to the illusion of control. And again, we can only try to mitigate the emotional biases. They will be relatively tougher to deal with, but we can keep detailed records of trades and motivations to segregate luck from good performance, maintain an investment policy statement and a strategic asset allocation to begin with, and do your investments based on that broader construct so that you avoid under diversification and other related issues of overconfidence. Self-control bias is a failure to balance short-term spending and long-term savings, or you can say it is a failure to address long-term goals due to insufficient self-discipline. So we sat with an advisor, we understood our long-term requirements, and we decided that we need to save so much and invest so much to meet our long-term objectives. We've seen that we end up spending too much in the short term or as things come up, and end up being not very disciplined about saving and investment. So this will result in insufficient savings at retirement, resulting in excessive risk taking later on, because the return required to meet your objectives now will be very high since you haven't saved enough. An overemphasis on income producing assets to meet shorter needs or shorter term needs. Detecting and mitigating is easy. You need to have well-defined goals and an investment plan. You need to budget your expenses and stick to the budget or work within that budget. And secondly, both your goals as well as budgets should be reviewed regularly to see if circumstances have changed and if you can actually spend more or if you need to start saving more so as to meet your retirement objectives. Status quo bias comes from the emotional desire to do nothing. So unless asked to review their portfolios and review their goals, review their asset allocations, investors left to themselves will not do it at all, or will do it much less frequently than is required. So eventually portfolios may become inappropriate with the risk and return characteristics not matching the investor's objectives. Investors may lose out on better investment options since they chose to stick to the original allocations and did nothing. So again, being an emotional bias, it is difficult to mitigate, but education about risk and return and proper asset allocation is the best mitigant to help with this bias. So you should continually speak to your client and continually make sure that he needs to revisit his portfolio and revisit his asset allocations. The fifth emotional bias is called endowment. So this is when investors place a higher ask but a lower bid on the assets they own, very commonly seen with inherited assets. So if you ask the value of the investor's house, if you're asked that what is the fair price at which you will buy the house, the answer will be $100. But what is the price at which you yourself will be willing to sell it? The answer would be $120. So investors place a higher ask but a lower bid. This may result in the investor failing to sell assets and failing to adjust his asset allocation. So maybe he doesn't need a big house in his portfolio. He needs more bonds and stocks. But because he's unable to sell the house because of his endowment bias, he's unable to meet his portfolio objectives. You end up holding assets that you are familiar with because they provide you a sense of comfort. So again, this house may be a dear property and hence he doesn't want to let go of it. It is getting him good rental. So even though it is inappropriate or inefficient, he doesn't want to let go of the asset. So this bias will be detected by asking the question that would you make the same investment with new money today? If the answer is no, then you should try to exit this investment or sell it off from your portfolio. So continually check to determine if the asset allocation is appropriate regardless of how long you have been holding the assets. So basically do not have an emotional attachment to your assets. The last and a very important emotional bias is referred to as regretaversion. So regret is a feeling in hindsight associated with making a bad decision. So understand, regret always comes in hindsight. That what if only I would have done this, or if only I had not purchased that stock, or if only I had purchased more of that stock. These feelings and these statements are a sign of regret. Individuals want to avoid regret. So they take decisions today so that they do not have to feel regret in the future. A lot of times we've seen that investors do nothing out of fear of regret or fear of making a mistake. If they don't buy a stock, for example, and a stock A goes up, that will be much less devastating to the investor than if he buys stock A and then the stock goes down. So investor continues to stick to his original portfolio because he has the fear of regret or fear of making the mistake of buying stock A. Please notice, this is happening because the regret is not as high if an individual stock goes up, because many stocks go up. But if you actively bought something and that stock went down, then the feeling of sadness is much more. However, theoretically, even if the stock goes up, you should feel equally sad because you've lost an opportunity that you were tracking. So sense of regret and pain from actions of commission or from doing something is higher as compared to actions of omission or from doing nothing. So investors end up doing nothing from the fear or because of the fear of regret. It leads to excess conservatism in the portfolio to avoid the feeling of regret when stocks fall. It can lead to suboptimal allocations and long-term underperformance. Regret aversion, very interestingly, is increasingly leading to herding behavior in the markets. So all investors want to go with the popular opinion, because even if this popular opinion goes wrong, everybody has gone wrong and the feeling of regret is not very high. However, if you went out of the way and you bought a stock that nobody else liked and then that stock goes wrong or it goes down, then the feeling of regret is much higher as you're the only one who's made the mistake despite everybody telling you otherwise. Again, an emotional bias, so tough to mitigate, but education about diversification, risk-return trade-off, and portfolio theory is the primary mitigant. So let's quickly revise the emotional biases that we studied. The first one was called loss aversion. That is, we do not as individuals like accepting a loss. Second was called overconfidence. And that was simply too much confidence in our ability to predict. The third emotional bias is called self-control, which basically said that we end up spending too much in the short run. Fourth was the status quo bias, which said that unless asked to reevaluate, investors do nothing. The fifth bias was called endowment, which said that you place a higher ask and a lower bid for the same asset or for your assets. which makes you end up not selling these assets and deviating from proper asset allocation. The last bias was Regretaversion, which is that investors want to avoid the feeling of regret. So what is the implication of biases on investment policy and asset allocation? So understanding behavioral biases, first of all, improves the construction and management of portfolios. Idea is to first understand the bias, make the investor himself understand and explain his biases, and then accommodate the bias in the portfolio or modify according to the biases, as we'll see in the coming slide. So the process of understanding the biases and accounting for them starts by asking the right questions. So what are the biases? Are they primarily emotional or cognitive? Emotional have to be accommodated to a larger extent, and cognitive can be mitigated with education. How do they affect the asset allocation? Or what is the client saying? Is he refusing to sell his house? Or does he want to over concentrate the portfolio in risky stocks because he's overconfident? So how is the bias affecting the asset allocation? Should the biases be moderated or adapted to? That is, again, should we accommodate or should we educate and mitigate the bias? Is a behaviorally modified asset allocation justified? What a behaviorally modified asset allocation is, we'll study very soon. And finally, what are the quantifiable modifications that we can bring into the portfolio because of these biases? So in contrast with the traditional finance theory, behavioral finance introduces the concept of goals-based investing. That says that investors should first establish the relative importance of each goal. So essential needs and obligations should be identified and quantified first. So living expenses, funding children's education are very important needs. So these needs should be funded by lower risk investments so that the minimum standard of living of the client is ensured. Desired outcomes are placed in the next bucket, and they include activities like having an exotic vacation, buying an expensive piece of jewelry, so on and so forth. These can be funded with medium risk investments, as even if these goals are not met, it will not deteriorate the lifestyle of the client. Low priority aspirations, such as donating a large sum of money to a charity, can be then funded with higher risk investments and with any remaining wealth if there is. So goals-based investing is essentially an endorsement of the mental accounting bias, or it deviates from traditional finance theory, but the advantage is that it is a relatively more consistent procedure with the thinking of the client. So the client can easily see that his more important goals are exposed to less risky assets and less potential loss. Hence, he will be more willing to accept a portfolio management theory like this or an allocation like this, rather than just giving him some obscure definition of standard deviation and risk and investing his portfolios in some basket of efficient assets or in some efficient portfolio. But again, structuring the portfolios like this would lead to a higher focus on fixed income securities to meet these essential requirements. So this kind of an approach is more suited to wealth preservation than to wealth maximization or wealth accumulation. So even though this approach may not be optimal from a traditional finance perspective, it will definitely be easier for clients to understand. So this is the goals-based investing theory given by behavioral finance. Now, very importantly, the behaviorally modified asset allocation considers whether it is better to moderate, that is mitigate and educate, or is it better to adapt the client's biases in the portfolio construction. If the client is independently wealthy and quite well off, then you can be more accommodative of his biases. That is, even if he has a bias, he wants a concentrated position, you can give in to his requests. If the investor, however, has a lower wealth, then you have to be more stringent and you have to focus the portfolio towards efficiency so as to meet his needs, because he does not have the luxury of deviating a lot as his wealth is already not very high. Generally speaking, cognitive biases should be mitigated, emotional biases should be accommodated for. So if an individual has high relative wealth and low SLR, SLR stands for standard of living risk. So if he has a high relative wealth and low standard of living risk, and the biases are primarily emotional in nature, then you have no option but to accommodate, because mitigating would be quite difficult. So you can allow a deviation of up to 12 to 15% from the traditionally efficient allocation. If he has high relative wealth and a low standard of living risk and biases are primarily cognitive, then you can accommodate and modify. So some biases would be easy, or you would be able to mitigate by education. So you are allowed a deviation of up to 6 to 10% from the traditionally efficient allocation. If he has low relative wealth and a high standard of living risk and biases are primarily emotional, then again some accommodation and some modification may need to be done. You're allowed a deviation of 6 to 10% from the traditionally efficient allocation. With low relative wealth and a high standard of living risk and biases that are primarily cognitive, you should try to mitigate most of these and educate the client. So you should deviate as minimally as possible from the traditionally efficient allocation. About 0 to 4% is what you would be allowed in this case. So these are not hard and fast rules, guys. You don't have to remember these values. Generally speaking, we're just trying to explain that emotional, you may have to accommodate more, and cognitive biases, you have to mitigate and try to remove these or try to reduce these biases from the investor's mind. So that was about the review on the behavioral biases of individuals. We'll now solve a few questions and try to understand these concepts better from the way they will be asked in the exam.